everyone. A warm welcome. Good morning, good afternoon, good evening to everyone from wherever you're joining. We are just letting all the participants in, and we are going to start in about 30-40 seconds. Please feel free to use the chat to introduce yourselves. So you're joining the session on blended finance for PPPs. We are going to examine the role of infrastructure funds and institutional investors today, and we have a wonderful panel with us. So I see all the participants are just joining, and the count is going up. I'm joining from Washington, D.C. It's a beautiful day here, and you will hear from other panelists. We are quite a global panel today here. All right, so I think we are ready to start. With that, I will hand it over to our president, Ziad Alexander Hayek.
Thank you very much, Jyoti. Good morning, everyone. I'm joining from Beirut, Lebanon. It's a pleasure to welcome you all to this third webinar in this year's WAP series on mobilizing blended finance for PPPs. Today, we continue our deep dive into technical aspects that address one of the biggest challenges in structuring public-private partnership projects, that of ensuring that projects are not just designed well, but also financially viable and investable at scale. In our last session, we explored project-level interventions, focusing on how public sector funding can expand the pipeline of viable projects and attract private investment by addressing early-stage risks. We discussed strategies that make individual PPP projects more bankable, including risk-sharing mechanisms, credit enhancements, and structured guarantees. Today, we will shift our focus a little bit and focus on portfolio-level interventions, a crucial next step in scaling blended finance solutions. Drawing from over a decade of lessons learned and best practices, we now recognize that to mobilize private capital at scale, we need standardized models that go beyond single projects and work across entire portfolios and funds by recognizing infrastructure as an investable asset class. In today's session, we will explore how institutional investors and funds can become game changers in infrastructure financing, enabling private investment to flow at a scale that truly transforms markets. This approach is particularly relevant for PPPs, where fragmented project-by-project financing often limits impact. By structuring investment opportunities at the portfolio level, we can create diversified, de-risked investment vehicles that are more attractive to institutional investors. As we look ahead, our next webinar on May 15th, I hope you join us for that then, will focus on local currency solutions, another critical component in making PPPs investable in emerging markets. With that, I'd like to thank our esteemed speakers for joining us today. I now hand it over to my colleague, Max von Abendroth. But before I do that, let me say a few words about him. Max is the chair of the Philanthropy in PPPs chapter at the World Association of PPP Units and Professionals at WAP, here in the elite public-private philanthropy collaboration at the Partnering Initiative, TPI, in Oxford, UK. Senior advisor for Europe and Germany at MDIF, a global $300 million blended capital fund sustaining media freedom. He is the former executive director of Daphne, today called Philia, which is the European umbrella organization of philanthropy, representing 10,000 public benefit foundations across Europe. Max, it's really a pleasure to have you moderating this panel today, and with our highly esteemed speakers. So I turn it over to you now.
Thank you very much, Ziad, for this very kind introduction. And it is indeed an honor to facilitate and moderate a session with such distinguished experts and panelists. So really happy to be here. The title today is Leveraging Infrastructure Funds and Institutional Investors in Blended Finance PPPs. And we bring together a group of speakers who shed lights from different perspectives on this topic, including concrete examples, which I hope makes it also very practical for all of us involved here. Maybe just two housekeeping points. You already started introducing yourself in the chat, which is excellent. So please continue with that. And don't hesitate to also share your LinkedIn link, because that's the only way, I think, in this kind of format, how we can really kind of connect with each other. And later on, we will also open a Q&A. And again, it will be the chat where you can ask your questions, and you can already put in your questions while the presentations are ongoing, so we can pick them up later on. I would like to introduce Chris Clapp, who is our keynote speaker today from Convergence Blended Finance, because this is a joint webinar between WAP and Convergence Blended Finance. Chris, you are the Managing Director in Convergence, and you're here today to present the blended finance models. You bring over 20 years of experience in development finance across different emerging markets, having previously worked with the EBRD and the EIB. Your insights will be invaluable as we explore strategies to scale private investment through blended finance. Before handing over to you, I just want to mention that we have also with us here Pablo Cevallos from the PPP unit in Ecuador, as well as Valerie Harrington from Blue Orchard, who is joining us from Geneva in Switzerland. Mark van Wijk is here from Infra Impact, calling in from Cape Town in South Africa. And we have also Salim Benzmail here from Meridiam, calling in from Paris. And yeah, I'm looking forward to facilitate this dynamic and solution-driven discussion and really highlight also the practical approaches to leverage blended finance for sustainable development. So please engage actively, come in through the chat, and so that we can have a discussion that really adds value to all of us here in the room. So I would like to hand over to Chris. Chris, the floor is yours.
Thank you very much, Max. If we could start presenting the deck, Jody, that would be amazing. So for all of you who don't know me and my organization, so we're Convergence Blended Finance. We were set up in Addis Ababa at the third International Financing for Development Forum Conference. So we've been around for 9 years or so, but we're really dedicated to one thing and one thing only. How do we use blended finance as a financial structuring approach to mobilize private investment into SDG and climate projects that happen to be located in the 142 low and middle income countries? It's all that my organization does. We're a not-for-profit organization that's regulated by the Canadian equivalent of the Securities Exchange Commission. And if you want to reach out to us, here are geographic persons. And the project I'm about to walk you through, the bottom three persons are the project managers for that. Next slide, please. Maybe we'll just go to the next slide. And I want to thank our sponsors, the Gates Foundation, Finland, France, Luxembourg, and Switzerland. So let me start here, big picture, before we go into some of the details here. If we go back 10 years ago to 2015, you may have all heard of the Addis Ababa Action Agenda. It was the outcome document of the third International Financing for Development Conference. And really, these conferences happen every decade. And they're really meant to create a North Star for the development and development finance community. So these documents, which will be renegotiated and re-agreed or new one agreed in Sevilla in June this year, really are meant to support and provide guidance to the development and development finance community. So one of the challenges we have, really, if we go back 10 years ago, there was very little mention about blended finance and private investment mobilization. So that one North Star that we had in the development and development finance community didn't have a lot of content about blended finance and mobilization. Well, the current draft of the new outcome document that's going to be finally negotiated and agreed in Sevilla in the summertime has a lot more content related to blended finance and mobilization. So we're going to walk you through a project that we have been working on for the last year or so about how do we go about standardizing blended finance. In many respects, the project that I'm describing to you today really is an action plan to achieve the investment and mobilization objectives of this outcome document. Really much oriented around standardized blended finance. To let everyone know, really the mobilization and blended finance over the last decade, it has been nothing but a failure if our objective is to mobilize at scale. Indeed, private investment on a cross-border basis from developed countries to developing countries in the past decade has been lower than it was in the decade before. There's $482 trillion of global financial assets, 88% owned by the private sector. Only 4 or 5% of it is in the developing countries once we exclude China. So private investors are not invested in the 142 developing countries. They're not investing in those countries. And the level of mobilization to get them to invest has actually been very poor and very weak. And we're trying to identify how do we reverse that moving forward. Next slide, please. So consistent with the new the Financing for Development 4 outcome document, we're trying to identify what would we need to do differently than the status quo if we wanted to mobilize private investment at scale to and within developing countries where that investment is investing in SDG and climate projects, PPPs or not. We've identified 4 critical components of how we would need to do things differently if scale private investment mobilization is our objective. Big picture, 76% of the low and middle income countries are rated B or lower. It means that on average, the median debt investment opportunity in these countries is single B or triple C. Broadly speaking, investors are going to remain invested in the global north if the investments that are on offer are single B or triple C. The only way for us to get them to invest at scale is how do we alter the risk to get it within their fiduciary and regulatory obligations, and how do we create a risk-adjusted return such that they can divest out of their developed market investments into developing. I'm going to focus today on the second component. How do we standardize and simplify blended finance or private investment mobilization models? Next slide, please. Convergence is dedicated to this space and this space only, and we have engaged with over 100 organizations over the last year under the ambit of, listen, the development community wants to simplify and standardize blended finance. We can't have 10 unique solutions for PPPs and 10 for gender and 4 for climate mitigation and 6 for agriculture. It's just simply not possible. What we've tried to do is we've tried to identify, well, what are the actual investment challenges we're trying to overcome that are relatively generic, and can we create a model of around 12 blended finance or private investment mobilization models that would ultimately address, let's say, 90% of the investment challenges. And then can we simplify and standardize around these 12, and then who would we be actually mobilizing? So we've really looked at this from many lenses. This needs to work for the 17 Sustainable Development Goals. It needs to work for the different investor types, and it needs to work for the different development themes and sectors here. Now, we've identified this model of 12 models. The 2 at the top vertically address public sector projects, and the ones at the bottom are addressing private sector projects. And on the right-hand side, we need to have local currency solutions. But broadly speaking, we think there are 12 models that will be doing one of several things. On that first column, how do we increase the number of viable projects? Now, a lot of projects that will become viable won't be seen as investable by many investors. The second column is, what can we do to increase the investability of individual projects? The third column is, well, most of the funding that we need to mobilize sits in the global north. They're not going to be investing directly in a project in Kenya. Therefore, how do we mobilize them through portfolios or funds? And then the last one is the risk mitigation on the right-hand side. Now, when it comes to PPPs, we've really identified those that are really important with yellow circles on a project level. And then the red circles are on a portfolio level. And the purple one is for local currency that could either be on a project or a portfolio level. We're going to walk you through a little bit of how this works now. Next slide, please. So once again, we've looked at the different sectors and development themes, and we've said, looking at these 12 models, whether or not we think that there's a very high importance or a high importance or no importance or medium or lower importance. So as you can see here, as we move across from different development themes and sectors, these models are not universal for all of the different sectors or development themes. Each model might work a little bit differently for each relevant sector or development theme, but we've looked at the main sectors and development themes to make sure, do we have fit for purpose models that will work well for all these development themes and sectors? And the PPPs are actually here. So as you can see, around 4 of the PPPs are not very relevant. 4 of the models are not really relevant for PPPs, but 8 of the actual models are relevant. Next slide, please. Now, just kind of mapping these models in relation to the classic or typical risks that we face when we're looking at investing in PPPs and developing PPPs. We've got 10 risks listed here. We've got a description of those risks and which of the private investment mobilization models, or PIMs, are most relevant for mitigating that particular risk. So we have solutions for each of these 10 that fit within some of these 12 models themselves. Next slide, please. Now I'm going to walk you through a little bit on how we want to be thinking about this of mobilizing for institutional investors. So the best PIMs, or private investment mobilization models for PPPs, are listed here. The 2 in red are the most relevant for institutional investors. The purple one is relevant for all projects and institutional investors, and the ones in yellow at the bottom are much more relevant for projects themselves. We talked about project level interventions last month, so we're going to focus today on portfolio level interventions. So if you look at these 12 models, and if we're going to standardize for all the sectors and all SDGs, and these are the 12 models, the 2 that are most relevant for institutional investors are the 2 blended finance funds at the top. One is a debt fund and one is an equity fund. And ultimately, we need to be satisfying local currency solutions, but that's going to be addressed in our next topic next month. So if we look at the top 2 here, how can we mobilize institutional debt investors into a blended finance debt fund where the institutional investor will be essentially saying, hey, I'm happy with the risk and I'm happy with the risk return, and I'm going to be investing debt into a blended finance fund where the fund manager is going to be making debt investments in PPP projects, either in one country, in a region, or all developing countries. Similar in structure is the next PIM number 11, where that's more related to equity. How can we create an equity fund where an equity investor, largely in the developed countries or global north, would be able to invest in a fund, and a fund manager then would be making either equity investments or mezzanine capital or subordinated debt investments in PPPs, either in one country or multiple countries or in all low and middle income countries. Next slide, please. So we're going to walk you through what that debt fund would look like. Now, once again, just step back for a moment here. We are endeavoring to standardize blended finance solutions that will work beyond PPPs, will work into infrastructure, will work into investing in commercial banks and microfinance institutions, will work across the board. We have found in engaging with others that the most appropriate or structure of a blended finance fund would have 3 tiers of capital in it, whether this is for PPPs or not. But within the PPP world, it's definitely 3 tiers of capital. If you look at this tier of capital, we are trying to remember we have a huge problem on our hands in low and middle income countries. The median sovereign risk rating is B minus. 76% of countries are B or lower. Therefore, we must be reducing risk. The most effective and efficient way to be reducing risk is in this structure here. The main 2 components of reducing risk here is, number 1, giving diversification to the investor, i.e. you're not investing in one particular PPP project. You'll be investing in a fund, and a fund will be making debt investments in multiple PPP projects. That could be in one country or multiple countries. And then we're also giving the investor a subordination of capital in the fund capitalization. So we can easily create triple B equivalent or formally rated by the big 3 notes or bonds in a senior position, depending how large it is. All we really need to do is diversify and ultimately have subordinated capital, in this particular case, a mezzanine tier of capital, which would be the equivalent of B or triple C, and a junior tier of capital, which quite frankly, to be honest with you, is going to be very high risk. And in all reasonable scenarios would be faced with facing an expected loss. Therefore, we can't get MDB and DFI capital into that. We can't get private capital into that junior tier. This really needs to be either developing country capital or actually that from the donor community, such as the OECD Development Assistance Committee. And in general, if you look at the history, and there's around 122 structured blended finance deals like this, we're going to need around 15% subordination in order to achieve a senior credit profile. That would be the equivalent of triple B. Now, if we can create this fund, we'll definitely be mobilizing a lot of institutional investors in a senior position because we're giving them investment grade notes or bonds. And all the funds are going to be investing in either bonds, loans, or AB loans for PPPs and infrastructure projects. Next slide, please. So the core of this, and this has been practiced at least 122 times in our historical deal database, we must give investors diversification. And one of the benefits we have of giving diversification, the big three rating agencies would largely say we'll get a 2-notch upgrade just simply by diversifying. So a series of underlying B-rated assets, we can get all the way to double B minus just simply through adequate diversification. And then the subordination of other funds, largely, that creates a first loss buffer. Therefore, if each of these assets or loans goes into default, indeed, if there's losses there, the defaults and losses accrue to the subordinated capital, i.e. the mezzanine and junior tier of capital, and not the senior investors. And through those two aspects, that's how we can create triple B investment grade notes or bonds in a senior position. Next slide, please. So to summarize that, if we can be getting around 20 plus loans into different PPP projects, we're going to be able to, through diversification, get a 2-notch upgrade, and through enough subordinated capital, around 15% in this case, we can get the senior notes getting into an investment grade position. Next slide, please. Moving away from debt for a moment and into equity. Once again, there are around 80 to 90 blended finance transactions that are tiered equity funds that are in our historical deal database. In reviewing those, for debt equity, it could be 2 or 3 tiers of capital, just to let you know. In this particular case, we've modeled 3 tiers of capital, but it's a very similar logic, whereby we are actually mobilizing equity investors to invest in the senior shares of a tiered blended finance equity fund, where the equity fund itself would be making equity investments, whether it's mezzanine capital or common equity, into PPP projects. This is less about the distribution of losses in the event that defaults and losses happen, but ultimately, this is about how do we take 3 types of funding coming in, senior shares, mezzanine shares, and junior shares. All of that money then makes equity investments, and then subsequently in years 5 through 12, when the fund manager is basically divesting or getting the cash flows back from their investment, they're asymmetrically distributing the money to the senior shareholders. In general, this happens until the senior shares get an IRR of 0 or a certain hurdle rate of, let's say, 5% before capital accrues to more junior organizations, junior funders. So in this particular case, by having the diversification and stratification of capital, we're creating a higher expected internal rate of return. We're creating a lower likelihood that the senior investors will actually incur losses. And this becomes less vulnerable to FX losses if the PPPs are across multiple countries with multiple currency risks that are happening. So with that, I'm going to pass back to Jyoti and Max, Max, for the rest of the conversation. Max?
Yeah, thank you so much, Chris. Excellent presentation. I think, at least for me, many things became more clear, and I'm looking forward now to kind of complement to this through the other speakers that we have here in the room. So I'd like to move to Pablo. Pablo Ceballos, you're calling in from Ecuador. I said that already before. You're a legal expert with a master's in administrative law from Santiago de Guayaquil University and a PPP structuring diploma from San Francisco de Quito University. You have over a decade of experience in public management, infrastructure development through PPPs. You're appointed by the President of Ecuador, Daniel Noboa, as Secretary of Public-Private Investments, and you're committed to attract private capital to drive national progress, boost economic growth, and enhance public services in Ecuador. Pablo, the floor is yours. Looking forward to your presentation.
Thank you very much, Max. Good morning, good afternoon, good evening to everyone, esteemed panelists and distinguished guests. It is indeed an honor to be here today to discuss how we can promote policies and strategies that drive dynamic, inclusive, and sustainable business activity and investments. As Max already presented me, I'm Pablo Ceballos. I serve as the Secretary of Public-Private Partnerships of the Government of Ecuador. I'm based in the capital city of Quito. Ecuador, a small country, South America, we are blessed with a rich biodiversity and significant investment potential. Under the leadership of President Daniel Noboa, our government is committed to increasing private investments, both domestically and internationally, in a dynamic manner that protects our diversity and aligns with the Sustainable Development Goals. In pursuit of this objective, we have diligently worked to establish 4 key policies and strategies aimed at ensuring security and stability in investments made in our country. These policies are essential for fostering private investments. Please, next slide. Firstly, we have implemented a clear regulatory framework. In December 2023, the National Assembly of Ecuador passed the Economic Efficiency and Employment Generation Law, containing in one of the chapters the Public-Private Partnerships Law. This law was drafted based on the World Bank's guidance on PPP legal framework. This law establishes the regulatory framework for PPPs, creating conducive environments that facilitate investments in infrastructure, project bankability, fiscal sustainability, and environmental sustainability. Second, we have prioritized transparency. This aspect is fundamental within the policies we have established as a country, aiming to promote public integrity and ensure transparency in PPP projects. In line with this commitment, Ecuador is proud to be part of the SOURCE community, a global initiative dedicated to promoting transparency and integrity in public procurement and PPP projects. Together with Transparency International in Ecuador, we developed a methodology for managing corruption risk in PPP projects, aiming to mitigate corruption risk from the project formulation stage to the project contracting phase, following international integrity standards and principles of open governance. Third, we promote well-structured projects. This new law encourages the formulation of projects based on common welfare, long-term sustainability, job creation, and consequently positive social impacts, such as the development of the influence areas of the project. Please, next slide. Our project portfolio includes 12 priority initiatives listed in the National PPP Registry, comprising 8 road infrastructure projects, 2 ports, and 2 hydroelectrical power plants, with a total estimated value exceeding $10.7 billion. These projects are well advanced in the PPP cycle, and according to our planning, will be put out to public bidding starting in 2026. In addition, we are diversifying sectors to attract investment to the country and are currently working on projects such as the national, and please move to the next slide. On projects such as the National Museum of Ecuador, water and sanitation treatment plants, a railroad system to promote tourism in the Andean region of Ecuador, logistic facilities for Galapagos Islands, and also other drinking infrastructure, water infrastructure for different local governments. The advancement in public-private partnerships since President Noboa took office has been remarkable and has deserved international recognition. As an example of that, we have climbed 9 positions in the InfraScope ranking of the IDB and Economist Impact, going from 15th position to the 9th position among 27 countries in Latin America and the Caribbean. Next slide, please. However, Ecuador faces significant challenges when implementing and executing PPP projects. One of them is political and macroeconomic risk. We have to take into consideration that in Ecuador, we don't have a local currency. We use the US dollar. So that mitigates our currency exchange risk. Facing election process and changes in governmental spheres generate an impact on macroeconomic indicators, such as country risk, which could discourage domestic and foreign investment. However, Ecuador went through an electoral process where President Noboa was re-elected for 4 more years recently, which ratifies the policies implemented by the national government to attract investments under the long-term PPP model. Furthermore, the country's history of fiscal instability raises concerns about the government's ability to honor its financial commitments. Nevertheless, the government of Ecuador, through the Ministry of Economy and Finance, has made important efforts to improve the country's fiscal situation. This work is articulated with the implementation of the National PPP Registry. Prior to registration, the projects were approved by the authorities in charge of government planning and public finance. Moreover, we have worked on guarantees and risk mitigation mechanisms, such as establishing trust funds for the administration of the PPP project funds, as well as political and financial risk insurance issued by multilateral organizations. To these ends, we have made significant progress with the Multilateral Investment Guarantees Agency, MIGA, of the World Bank Group. Another point to mention is the lack of developed local financial instruments to finance long-term infrastructure projects. Faced with this challenge, we still have some way to go. Among them, we must promote a regulatory changes that allows local investors and financial institutions to have financing mechanisms adjusted to PPP projects. Another essential aspect is to build specific capacities under the PPP scheme for the services offered by local banks. Next slide, please. Ecuador has made significant progress towards achieving a successful PPP agenda. We are regaining international confidence through our management with modern regulation and robust PPP projects. Now the challenge is to achieve their bankability. For this, we work hand in hand with our allies that guide us through the best international practices. Please feel free to any questions. I know that the juicy part is the Q&A, so I will be glad to answer your questions. Thank you very much.
Wonderful. Thank you so much, Pablo. It's great to get your perspective from your country and your context. And maybe I can just ask you your first question about when looking at the situation in your country, and in particular the challenges that you just outlined. How do the models that Chris presented before resonate with you in terms of the risk mitigation when it comes to the equity side, but maybe also in context of the diversification of a blended fund that helps to kind of increase the rating of your fund?
We face different challenges, and it's not only a matter of the national budget or the fiscal capacities. It is also a matter of what is called the fiscal spaces or the assignation of the fiscal budget to the institutions. as a government, we can have some capacities to assign budget to projects or fiscal space, but the institution have limited space in the budget. So in some cases, we have some financial resources, but we don't have fiscal space. Considering the fiscal regulations. So the blended finance mechanisms can help us to reach bankability for our projects and to establishing mechanisms outside our fiscal spaces and fiscal regulations that will allow us to reach financial closure of the financial close of our projects, and to and at the same time fulfill our fiscal restriction and regulations. That is our perspective that's that we see as an opportunity with blended finance.
Great, thank you. Maybe Chris, if I can come to you for a moment. From what you have described as the models and also the many projects that you have looked into to come to the conclusions within the PIM approach that you presented, how does that resonate for you, what you heard about the challenges that Pablo is describing for Ecuador, and where do you see the opportunities of the blended approach?
Yeah, so I think, Pablo actually mentioned what is a key constraint for most developing countries. Ecuador has a split rating. It's B- for some rating agencies and CCC+ for other rating agencies. In general, that is not going to be attracting a lot of institutional investment on a cross-border basis, sadly. Okay, so we need to be working to create much more affordable sovereign loans going into the government of Ecuador and other countries. One of the 12 models creates BBB pricing going into countries like Ecuador through a blended finance model. We need to get more funding going into the Ecuadorian government in much more affordable terms. Hopefully, some of that will be allocated to PPPs. Now, beyond that, in the private sector, we're not going to be attracting cross-border investors at scale to Ecuador at a B- and CCC+. Therefore, how do we do that? Well, the two models that I described attracts debt investors into the private sector and equity into the private sector. If we can diversify investors' risk, where Ecuador is part of the exposure, into a portfolio of debt, then we can actually add Ecuador into a portfolio, and through subordination and diversification, we can get senior investors into investment grade. Now, within Ecuador, okay, now we also need to be endeavoring to keep, let's say, Ecuadorian institutional investors invested in Ecuador. So one of the models is, how do we create an entity that will issue BBB guarantees so Ecuadorian banks and Ecuadorian institutional investors can keep their funding in Ecuador, because they'll have an investment grade risk. So all of the PIMs are addressing the exact issues that Pablo discussed. And, once again, Pablo just described Ecuador. 76% of developing countries are rated B or CCC. So Pablo's challenge and Pablo's government's challenge is completely indicative of the 142 developing countries out there. Only 10% of them are investment grade. So we need to be working with Pablo and his government to really identify the best models that will get a lot more SDG and climate projects funded, despite the fact that Moody's is rating these countries B and CCC.
Okay, fantastic. Thank you very much. And I will open it up now to the other three colleagues and experts here in the call to get their perspective as well. And then we can come back on this specific example. But thank you, Chris and Pablo, for making this really concrete. And I'd like to turn to Valerie. Valerie Harrington, who is a senior fund manager at Blue Orchid Finance in Geneva, as we said before, overseeing blended finance mandates and developing investment initiatives in emerging markets. You recently led the launch of Blue Orchid's gender diversity and inclusion strategy in Latin America. Previously, you worked as an investment advisor at Panama's largest bank, and you hold an MBA from SDA Bocconi and a BS in Finance and International Business from Georgetown University. Valerie, I have a question for you. So from your perspective, and we understand that Blue Orchid is not investing in infrastructure, how does the blended finance work at portfolio level? And can you maybe explain this along the lines of an example?
Hello, good afternoon. Yes, Max, with pleasure. I just received a message from my computer that it will reboot, so I've joined audio from my phone just in case. And now it's rebooting. So here I am on video. So indeed, Blue Orchard is an impact asset manager with, at this point, 25 years of track record investing in impact investing in emerging markets. We have approximately 5 billion in assets under management, out of which 1 billion approximately is in 8 different blended finance funds at Blue Orchard, right? So it's not something that we do for all our funds. It's something that we do when we determine that it's needed to mobilize private capital, right? And so we very much align to what Chris presented as sort of the different archetypes in terms of fund structures. And so maybe useful to share an example of this last strategy that we launched in 2024 on gender diversity and inclusion in Latin America and the Caribbean. So there, it's a debt fund and it has 3 different tranches of capital, let's say, right? And so the junior tranche of that capital is provided by OECD, ODA, sort of funder, in this particular case, Canada. And they are the ones taking, let's say, the highest risk and the lowest financial return within the strategy. So it's catalytic blended capital. We then have a mezzanine tranche in the structure that is taking sort of medium risk and the highest return. And this is typically funded by development finance institutions. In this particular case would be IDB Invest, given their interest in Latin America and the Caribbean, of course. And then as the most senior tranche of capital, we would then have the private sector investors. And so this structure allows for the senior investors to have a relatively safe investment profile, despite being in a regional fund for Latin America and the different credit ratings that these Latin American countries have, as Chris mentioned, right? And so in this particular example, there we have as investors a Swiss pension fund, as well as family offices and impact investors. And so, of course, this is a structure that we try to replicate across our different strategies, of course, in different variations of proportions, right? We do try to be as to have as low catalytic capital as needed to mobilize private investors. And of course, as well, the return that these different investors may have, the tenor of their investment, as well as the tenor of the fund, depends on what we're doing on the asset sides, right? So in this case, it's a 10-year strategy, but of course, it could be longer or different in terms of the details for infrastructure funds as the ones that are being discussed here. Another thing that we use blended finance for and that we find very impactful as well is technical assistance facilities, right? In this example for Latin America and the Caribbean, we have, let's say, alongside the fund, in parallel, a technical assistance facility that is also funded by Canada. And there we use this funding as a cost sharing with the institutions that we're investing in to really amplify the impact. So do capacity building at the institution level, to help us improve and measure as well the impact of the fund. So that's a bit how we use blended finance at Blue Orchard.
Fantastic. Thank you very much, Valeria. I'd like to come back, but maybe after we heard the others on this impact aspect, because we heard a little bit about this from Chris with the SDGs, and you have a concrete case here, so maybe we can talk about that as well. One question I have to you, when you talk about private sector investors, so what kind of investors are these?
Yes, so in this strategy in particular, we have a Swiss pension fund as the largest private investor, but we also work a lot with family offices, so wealth management clients, let's say, corporates as well from their balance sheets. In some cases, invest insurance companies as well are part of the client base of Blue Orchard, as well as foundations. And private banks.
And the foundations, would they come in from the endowment side?
It depends, right? We have had foundations play a more catalytic role, so being part of the blended finance of the strategy. And we have, in other cases, yes, being more investment-minded, part of their sort of balance sheet of investments, more in the senior part of the strategy, depending as well on their size and their capabilities, right?
Fantastic. Thank you very much, Valerie. I would like to turn now to Mark van Wijk. You are a co-founder and CEO of Infra Impact Investment Managers based in South Africa and responsible for strategic development of infra impact in investment execution and management. Infra Impact is a specialist infrastructure investment manager focusing on waste, water, renewable energy, and digital infrastructure. Mark, the question I have to you is, how has Infra Impact overcome regional challenges regarding project funding? And do you see south-to-south investment risk return profiles any differently than traditional north-south?
Yeah, thank you for that question, Max. And thank you for the opportunity to participate in this. Yeah, so in terms of, let's call it like, the south to south, or just the south in general, investment case, investment theme, and specifically speaking about Africa. We know that, Africa needs like, trillions of dollars of infrastructure investment that need to take shape on the continent. And unfortunately, the amount of local-based capital to actually facilitate that is not available. And so obviously that creates a challenge. And so I'm quite commendable on the work that Convergence is doing together with WIPE in terms of coming up with ideas as to how we can assist these low to middle income countries to mobilize capital into the opportunity sets that presents itself. So and I do think there is a definite like a risk premium, and therefore we need to kind of figure out mechanisms to reduce that risk premium with risk mitigation strategies, as previously mentioned. And it's going to take a collective effort. From a South African context perspective, we're relatively blessed that we've got a relatively large local pension fund base with trillions of rands of capital looking for long-term investment opportunities that's inflation-linked, which then lends itself very nicely to infrastructure-like assets and PPPs itself. And so given that context as well, and the increase of demand for PPPs and infrastructure assets in South Africa specifically, is that our very few infrastructure and PPP projects that we've had in our market has been performing, in that we haven't had any defaults on the loans, and the equity investors have been rewarded for their risk. And then secondly, and very importantly, is that these projects have actually managed to survive multiple different changes in terms of governments and administrations, which is obviously a big risk from a political point of view for these 20-25-year-like projects. We have been, there's been also demand from both pension funds, insurance companies, and development financing institutions within South Africa for mobilizing capital. And I think also an important point is that given the regulatory environment and the legal enforcement in terms of user pay concept, whether it's in the water or the energy or transportation sector, is that you've got government support to enforce user pay regulations, and therefore facilitates and give comfort to the institutional investor market that there's a high level of certainty from a political risk perspective that their returns are protected in a certain way. Having said that, in terms of the project development where you started out earlier, we've had some challenges in terms of projects being developed effectively and being packaged appropriately for institutional investor market to participate into it. We've had a number of different institutions, both at national government together with provincial governments, looking to find ways to streamline the development of projects from a PPP perspective, and also to reduce the cost and the time to bring those projects to market. And therefore, I think it's important, finally, or in closing, that the blended finance models, together with the standardization, create certainty in the market and allow for a market to develop for these projects going forward, and having the market participants not having to reinvent the wheel every time something happens. And so I think that is critically important as this market unfolds, both in developed and in developing markets, that there's a, let's call it consistency, which will allow for a reduction in transaction cost and also speed of execution, and therefore a more effective and efficient participation in the market. Thank you.
Thank you so much, Mark, for making it really concrete for the South African context. Chris, you raised your hand. I imagine you want to come in and comment or ask a question.
I just really want to re-emphasize what Mark's saying. Mark's hit the bullseye straight on. You know, the world of blended finance and mobilization currently is a series of fragmented, random, customized, unique blended finance transactions that take 2 to 3 years to get done. And the average size has been around 50 million at the end of the day. We're killing ourselves, losing donors. We have to simplify and standardize. Otherwise, 10 years from now, we'll be exactly where we are today. A series of random, fragmented, inefficient, ineffective solutions. And ours isn't necessarily the best model. We're just trying to get a model that is fit for purpose, that we need to be implementing sooner rather than later. Let's not wait for perfection. Let's just get something that can standardize and simplify and moving forward. Because at the end of the day, whether it's Mark's country or Pablo's country, you know, in general, investors always remember there's no money sitting on the sidelines. All this money is invested, but it's invested in China, it's invested in developed countries. If we want to get it into developing countries and the median sovereign risk rating is B-, the core of this needs to be, how do we standardize and reduce risk to create investments that will meet investors' regulatory and fiduciary obligations? Otherwise, they'll stay invested in North America and Europe.
Thank you, Chris. My question to you, building on this, you talked about the uncertainty that exists in the market. Do you think that, how would you think these kind of models that Chris introduced before would lead to building more certainty in the market and therefore reduce the risk from the perspective of investors?
So was that a question for me, Max?
Yes.
Yeah, no, I definitely agree with what Chris is saying. I think, you know, and you see this in other security markets as well. There's a standardization. There's a reason why derivatives are traded in a certain way. There's a reason why bonds are issued in a certain way. There's a reason why equity, warrants, etc., are structured in a certain way on a global basis. And in that way, it creates a more efficient market. And so there's definitively a need for standardization. And that will facilitate the mobilization of capital into the areas where we need to go. And I agree with what Chris is saying. Is like, you know, you will never get the perfect solution. You have to move with the beta version, and then from the beta version, you kind of graduate to next versions, and eventually you get to the end result. But as he rightly said, it's like you're never going to wait for the final 100% perfect product. You have to move, and in that movement, you start seeing as to where there's areas for improvement. So I can't agree more.
Okay, excellent. Thank you. And maybe just one last question to you before we move on, more for understanding. You said in the beginning that local capital is not available, and I was wondering if it's really not available or if it's just hard to mobilize. Mark, also for you, this question.
Oh, so in terms of local capital, sorry, I might have maybe said it incorrectly, but we have a deep base of local capital in South Africa.
Yeah.
And there is definite intent from both institutional and mainly trade union-backed pension funds to mobilize capital to develop our country after the ravages of apartheid like 30 years ago. And so there is a deep base of capital. It is just to allow, we need mechanisms that can enable us to mobilize those capital into the areas where we need it to go. And so blended finance solutions is definitely one of the solutions that can assist us in unlocking some of that capital.
Right. Thank you, Mark, for clarifying this. Okay, great. I would like to move on to Salim Ben-Smail. You're a senior investment director at Meridiam, a Paris-based independent benefit corporation specializing in the development, financing, and long-term management of sustainable public infrastructure. Salim, having just heard from Ecuador, and given Meridiam is one of the unique funds which has been able to underwrite emerging markets risk in infrastructure investments, what would be your top 3 practical policy advice for other funds and institutional investors to clients like Pablo?
Well, it's not an easy question. I think obviously we were drawing on the experience that Meridiam has had in developing and investing in greenfield infrastructure projects in Africa for the past 10 years. We're already at our 2nd generation of funds and already actively looking at the 3rd generation of funds to invest in Africa. The fund that I'm responsible for actually it's a bit quite interesting in relation to the discussion today is called the Urban Resilience Fund. And this is a fund that targets projects and supports cities and municipalities and governments for urban projects. And actually, so we have one arm of this fund, which is investing in Europe, and the other in Africa. And in Africa, the African vehicle is actually a portfolio blended finance approach, because we have 3 layers of capital that have been mobilized into the fund. We have a concessional tranche, which has been funded primarily by the Rockefeller Foundation, which was the initial partner, and the EIB with a guarantee from the Luxembourg government. And we also have a senior tranche, which may work a bit differently to things that we've heard previously, which serves a preferred dividend at a relatively competitive rate. And then we have the normal equity tranche, where we try to bring in more traditional investors. And so effectively what's happening is the concessional tranche is reducing the risk of the equity investors, and the senior tranche is improving the returns and providing a kicker on returns. And we're hoping this structure can be a solution to try to bring in more traditional private investment in these markets, which are obviously more difficult. Now, if I think in terms of what lessons we're drawing here, I think the first is we find it very interesting and useful to involve our public partners and governments in as co-investors in projects. That doesn't mean they need to take a very large stake of projects, but we do think that having skin in the game also provides them a lot of transparency and creates a lot of confidence, as we need to discuss what potential guarantees, support mechanisms need to be brought in place. And then there's full transparency on the economics of the project, and I think that's a very important contributor to the success of projects. The second thing that we're a big fan of, I think, is what we would call co-development models, or progressive delivery models that I think have been discussed in the recent past as part of this forum. I think these models, where private investors or developers are brought in earlier to support the development of projects at an earlier stage, I think can be very powerful, because at the end of the day, an investable project or a bankable project isn't, bankable in reference to a theoretical definition of what bankability is. It's bankable or investable if there's somebody that's actually going to put money in the project. And so having investors on board at an early stage, provided you put in place, and we're very careful about that, the right transparency for this early stage mobilization, but having investors on board earlier in co-developing the project, we think is a very powerful tool. And just a final message on, with TURF, the fund that I'm responsible for, so we do have this structured approach, this built-in blended finance structure, which we hope can create very appropriate conditions for private investment. But it's no substitute for getting the right risk allocation in project structuring. And I think it's important to all agree that what we're trying to achieve through blended finance is not to make inappropriate or unacceptable risk allocations or risk transfers acceptable simply because we've sort of engineered a boost to returns. We don't think that's a good approach to project development.
Thank you so much, Salim, for sharing your learnings also from your approach. One question to you, directly building on what we heard before from Chris about the private investment mobilization models. So looking from your perspective, where do you see the opportunities, but maybe also the challenges of working along these standardized models in emerging markets?
I don't want to strike a discordant note in the discussion. It's just that our experience in the market in working in projects in Africa has really been that projects are very singular, and it's very difficult to have a very standardized approach to many of the projects and the challenges that we face. Now, I'm not at all suggesting that this isn't a useful approach. Yes, this needs to progress, but frankly, I've been on the policy side working in France. I was involved in the network of PPP and infrastructure officials with the OECD, and even in mature markets, standardization is a challenge. So it's always going to be a challenge. It's something we must strive for, but it's never a complete substitute for getting our hands dirty at the project level and coming up with customized solution. And that's also a message to the blended finance community, the DFIs, the MDBs, is that we need to promote a culture where these institutions that provide the instruments for blended finance and guarantees and support mechanisms to projects, where these institutions have an appetite to take risks. Again, I've been on the policy side. I know how difficult it is when we are playing with taxpayer money or foundation money, or it's difficult to take risks with this money, with the kind of structures we put in place. But I think those projects that are very difficult, that have actually worked, is where not only the investors have taken risks, but also the policy side has taken risks in the instruments that it is willing to put in place.
Thank you very much. Chris, I see that you would like to come in on this one.
Yeah, I just want to listen. First and foremost, I really want to applaud Meridiam. Okay, Meridiam's an incredibly important asset manager, fund manager for us to get more PPP and infrastructure projects done. We'd love to see Meridiam get larger, and we'd love to see Meridiam multiplied such that there's less of a unicorn in the world that we're in. I just want to emphasize for everybody, what we're doing isn't working. We need to scale. Our project is really, how do we raise funding in a standardized way, and how do we mitigate the risks in a standard way? As Salim says, you cannot standardize and simplify and solve 100% of the investment challenges. It's simply not possible, okay? And nor does this project endeavor to do that. We need to simplify and standardize, so we need to give investors what they need and want. Hey, I'm already invested in developed countries. What you're offering me really isn't attracting me to divest. We need to give them something that will ultimately allow them to go to their investment committee and their credit committees to say, hey, I've got a pretty good deal here, and it looks like it's better or equal to where we're currently invested, okay? We need to create that. Otherwise, we'll be 10 years from now and we won't be there. So Salim's absolutely right. This is not about solving 100% of the challenges that we face, and every deal will require a level of uniqueness. And therefore, sometimes the standardization may not work all of the time. But we need to be solving for not just PPPs and not just infrastructure, but for the 17 SDGs. And our view is we really can't standardize beyond around 12 models, because at some point the public sector says too complicated. We need to give it relatively simple for the public sector, and yet enough degrees of freedom to give Salim and his colleagues to use these models to raise funding and uniquely solve their challenges, maybe with different approaches, but this 12 will certainly help him raise funding and address the investment challenges that he and Meridiam face.
Wonderful. Thank you very much, Chris, for putting this into context. I have a few questions here in the Q&A box, so thank you very much for all the participants to adding some questions here. And I'd like to pick one for Pablo from our participant called Carlos Casio Carraro. He is a co-founder of a fintech in Brazil. The question is, how open is the Ecuadorian government to carrying out financial operations to support its projects through blockchain technology? This represents a significant opportunity for international investments. Pablo, do you have a view on that?
Thank you, Max, and thanks for the question. I know that in the private sector in Ecuador, different initiatives regarding financing and funding through blockchain technology are being carried out. On the governmental sector, at national level and subnational level, we are not aware of any initiative of financing through blockchain. But of course, as a government, we are open to and analyze the different options. Chris mentioned and described the challenges that a government like Ecuador is facing regarding financing, and we're pretty aware of it, and we are working in different strategies. Of course, in this initial stage of the pipeline, we are getting all the advice of the MDBs. We're working with IFC of World Bank. We're working with IDB, and in this first stage, we're working with the private divisions of the MDBs. So, but we know that for us to scale our financing in our projects, we need to develop other mechanisms, not only the ones provided by MDBs.
Okay, thank you very much, Pablo. That is very good. I have another question here which I would like to put forward. How can early stage project preparation be better supported to attract private finance down the line? I think, Salim, you talked a bit about that. Do you want to come in first, and then please others feel also free to come in?
I mean, there's a lot of money being thrown at early stage project preparation across DFIs and MDBs, and I mean, and that is that's obviously very useful. I can, and I don't claim to have a very comprehensive answer to the question that's been asked, but I would just reference our experience at Meridian and with the Urban Resilience Fund is that we actually, in addition to the main investment fund, we have something that another investment vehicle, which is called the Catalytic Capital Fund. And this is a pool of money, 20 million euros or so, which is available to offer pre-financing to governments or municipalities or cities for the early stage project preparation work. Now, what we've done with this is it's been structured as a fund. We're not looking to make a return on this, but what we're trying to do is make sure that we get the money back. Why are we doing it in this way? We're doing it in this way because we want to change the incentives that the different players, and including the public sector, have in the early stage project preparation phase. So effectively what we're doing is we enter into agreements, MOUs with governments, where we agree to support the government, work with the government on early stage project preparation. We can provide funding and at least financing for this. And if for some reason the governments decide not to go ahead with the project, then, well, they have to pay the money back. And I think that changes the incentives of technical assistance, of early stage project preparation. And I'm not advocating that all of technical assistance should move away from grant funding and subsidies and free money, basically, and turn to these more incentivized schemes. But we do find that it is creating interesting incentives. For example, this is the way that we worked with the government of Mauritania on a project in my fund, which is a project to protect the coastline of the capital city of Mauritania. And we conducted early stage project preparation studies under this approach, mobilizing the catalytic capital funding. And then we've eventually moved on now to set up a joint venture company with the government to develop this project, which hopefully will protect the city from rising sea levels, which is an issue that's really been plaguing the city for quite some time.
Great, thank you so much, Salim. I'd like to stay in the same area and maybe turn to Mark with a question from the audience. Not sure if you can answer to this, but we'll give it a try. How does the demise of USAID, as we know, it affect blended finance projects to access project development resources?
Oh, very good question. We have definitely been impacted negatively by the demise of USAID. Just to put it into context, USAID was instrumentally involved in developing of South Africa's first water PPPs more than 30 years ago, and has been quite instrumental involved in also facilitating the establishment of new private market fund managers specifically for infrastructure investment. And the abrupt stoppages of USAID obviously leaves a big gap within the South African context because they've always been seen and trusted as a good partner for us.
Good, thank you for clarifying this. I'd like to turn to Valerie on the question of impact. You, in your intervention, you explained that the technical assistance facility is also, or the funding that comes for this is also about developing impact measurement. I was wondering if you could elaborate a little bit on this, how that looks like in the context of Blue Orchard and the funds that you're setting up. Also in the light of what Chris said before, that the blended finance models that we are talking here about should kind of add and play into the SDGs.
Yes, happy to. So the majority, I mean, we're an impact asset manager, right? So all the investments we do are categorized as impact investments, and the majority of them are done without technical assistance facility support, right? There are just some funds that are very specific in terms of the impact intent that they have that have a technical assistance facility tied to the fund, right? But in a general sense, we have what we call the B impact proprietary impact management framework, right? That includes, of course, a very robust sort of ESG analysis for each of the institutions that we work with, and the institutions need to pass a minimum threshold in order to be able to be eligible for Blue Orchard funding, let's say. And then an impact assessment that is, of course, aligned with all the different impact frameworks and best practice that is specific to each transaction and specific to each fund, right? Depending on what is the impact strategy of each of our vehicles. And then there are, as I mentioned, very specific ones like this one in gender diversity and inclusion. We also have one on climate adaptation, right? That are strategies that require a bit more support in the sense that they're a bit more innovative. And so the investees sometimes qualify for technical assistance support that, as I mentioned, needs to have a cost sharing, right? So they also need to have skin in the game to make sure that they are incentivized, as Salim was mentioned, to develop, finalize, and implement these projects. And so that's, I would say, that the main part of the technical assistance facility, sort of helping these institutions develop new strategies that are impactful. But yes, there are parts of impact management that we cannot do just with our analysis, right? In terms of data gathering, especially we do a lot of financial inclusion. And so we want to hear how the loans impacted the end borrower, right? And so for that, for example, we use technical assistance funding to conduct surveys really in the market. And that helps us really put more emphasis on the voices of the end beneficiaries that we're trying to impact. And so for that, technical assistance is needed.
Very good. And if I understand correctly, the funds that you're running at Blue Orchid are not necessarily funds like impact first, but finance first with impact. Is that correct?
Yes, for us, both are important. And there's, of course, as well room in, we see it as a spectrum now. And so on one side, you have traditional finance, and on the other side, you have philanthropy in the two really extremes. And so we work in impact investing, in which our transactions really need to have a appropriate risk return and at the same time.
Yeah. Okay, great. Thank you, Valerie. Is anyone else here on the panel would like to contribute to this or add something from your perspective related to impact? Yeah, Chris.
Oh, sorry. Then you said impact. I just really want to go back to Salim's point, because in general, all investors, MDBs and DFIs generally say, including Salim and his colleagues, there's not enough quote unquote viable projects or investable projects out there. We all know that. What Salim's absolutely right. There's a huge amount of funding flowing to governments and to MDBs. That's usually grants to quote unquote develop public sector projects, and some of them are PPP projects. On the flip side, there's MDBs and DFIs don't invest at all in private sector entities developing projects. It's an area that they don't invest in. We need to get a lot more funding into private sector companies, whether that's Salim's group Meridium or some of the African renewable energy project development companies. They're systemically underfunded. MDBs and DFIs find the risk to be too high. How do we take what we've learned from the project preparation facilities for public sector and PPPs and inject more funding into private sector projects that will largely be infrastructure that won't necessarily be undertaken on a public sector or PPP basis? And that's one of the actual PIMs of the 12 models. If we don't create a larger supply of viable projects, then creating a larger supply of funding is a waste of our time. We need to get a larger universe of viable projects, whether they're public sector, PPPs, or private sector. And certainly in the private sector, MDBs and DFIs think it's too risky. They don't fund it. Therefore, what other public sector funding can we get to private sector development companies so we can develop more viable projects?
Yeah, right. Maybe, Salim, this actually relates very nicely to a question that is in the chat about, as investors usually ask for higher return in Africa due to the risk notation, what should be done to improve that perception of risk, which is sometimes not well correlated with the reality on the ground? Do you have an answer for this?
Well, actually, I'm going to cheat because I think I just got a message from Charles who asked that question, saying he's had to leave, so he's left me with this question.
Okay.
And so, no, but jokes aside, I don't know if I would, agree with the premise of the question. I'm just saying, is it just an issue, a matter of perception of risk, which is inadequate in comparison to the reality of risks on the ground? I think Meridium's experience in Africa is in working in infrastructure. Even staying outside of markets that we feel are simply just too risky in terms of rule of law, which are just the basics of what we need to create an investable environment. But even so, the risks are genuine. There is political instability. There is macroeconomic risks. There are fiscal, the fiscal situation of many states is extremely difficult. There are local, there are currency issues. So no, I think the risks are significant. They are significant. That's why these projects take. They do require relatively significant, rates of return and risk premia for if you want to attract investment. But the way to solve the problem is not just working on perception, but working on the reality of the risks that are embedded in the projects and finding solutions to address them.
Okay, great. No, that's thanks for this. I would like to turn to Pablo one time with one question here in the chat or in the Q&A box, which is, how are you able to contact international investors or any interested players? Is this through networking or any structured approach? And now the question disappeared. Sorry. But so the idea is how are you able to reach out to international investors for Ecuador?
Thank you for the question. We are delivering. Actually, we're working on the pre-feasibility and feasibility stage of the projects. We're working on the engineering and also in the financial structuring. Part of the duties of the structuring firm is to promote a market sounding of the project. So in the first place, the structuring firm will promote a market sounding of the project. But also we are part of an international community, of a platform called Source, and where you can, when the government can promote their projects. So, and our webpage, all our projects are uploaded at Source with all the available information. In the presentation, you can have all the contact information. So if anyone wants the presentation, feel free to deliver it to them. And you can have in this public platform, public access platform, all the available information of the project, the profiles, the feasibility or pre-feasibility studies once they are approved, and all the government authorizations. And of course, we are open to any direct contact through our channels, to our social networkings or emails, etc.
Great. Thank you very much, Pablo. So I hope that people in the audience listened carefully to that. Now, what I would like to do, because we're coming towards the end, is just finalize with one question that you can all briefly answer as a closing round. And that is really, what can you do at your end to move to the standardization that Chris was asking for in the blended finance field? So what could be this concrete step for you to move in this direction? Who would like to start?
I think you can go for it, Valerie. Go for it.
No, I was just going to say we are closely collaborating with Convergence in this process, providing our experience, and then of course open to the final sort of models that come out, and adjusting if needed our different structures to the ones that are applicable to Blue Orchard. No, but as Chris mentioned, I do think it's a very conversational approach in which they're asking for input from the market, also to reflect what us as the managers know that investors are requesting or expecting.
Okay, great. Thank you, Valerie. I would like to, Mark.
So I think from our side, I think so there's an entity called in South Africa called the Gauteng Infrastructure Financing Agency, and so they've been leading a lot on it's called one of the province's infrastructure and PPP kind of development, and as a developer, and so engaging with them in terms of the standardization of the documentation between themselves and National Treasury, and then I think a second part of it would be to introduce. There's an association for investments in South Africa that basically represents the interest of all institutional investors, insurance companies, and pension funds in South Africa, and to bring them on board potentially as a partner in this discussion. Mm-hmm. And then I think lastly, I think the LTIA, which is the Long-Term Infrastructure Association, would also potentially be an interesting partner to kind of bring on board on a journey like this.
Great, super. Thank you, Mark. Salim.
I think I can, I'll say first, the first thing I can do is maybe let's have a follow-up call with Chris at some point, because I'd definitely like personally to know more about the work that's being done at Convergence. But I think Meridiam is already actually quite involved in a number of marketplace initiatives. Obviously, the Long-Term Infrastructure Investors Association is something that Meridiam has supported and continues to support very closely. And the Fast Infra initiative is also something that we are pushing forward quite heavily. So yeah, quite a few things going on that are going in the direction. I think that the standardization objective that Chris is promoting.
Yeah. Great. Thank you, Salim. Pablo, what would you do to help the standardization to become mainstream?
From the government perspective, it is highly important to have standardized models and structures, or business structure for our projects. So regarding PPP projects, under our local law and regulations, it is mandatory to have a standard model of contracts, standard model of transactions. So I feel that regarding blended finance, we should move in the same path, considering our regulations and to work with standardized models approved by the national committees for PPPs or for debt. So I will feel that from the government perspective, that will be the way.
Great. Thank you, Pablo. And now, Chris, over to you.
Yeah, especially while we have Mark on the call. Listen, at the end of the day, who cares about standardizing blended finance? Blended finance is just a tool to do what? It's a tool to get more SDG and climate projects implemented. There's not enough investment money in Africa to achieve the SDGs and climate objectives. Africa is the riskiest continent, just empirically. The median sovereign risk rating there is CCC+. Africa currently is missing out on the mobilization agenda in blended finance at scale. Best estimate is there's around $5 billion of private investment being mobilized to Africa. Pablo, I'm not being negative for Ecuador, but in general, sadly, the challenges in Africa are bigger than in Latin America. And quite frankly, you have Inter-American Development Bank that is 5 times larger than African Development Bank, as an example. Asian Development Bank is 6 times larger than African Development Bank. So Mark, we'd love to work with you in your role. We were in Africa last week, really trying to implore the African country leaders, the governments themselves in Uganda. Blended finance and mobilization does not work for Africa. The status quo is not working for Africa. And the changes that we see will not work for Africa. I'll give you an example. There's $480 billion of capital in the MDBs. There's 40 billion of capital in the DFIs. Around 1% of that capital is used to reduce risk and mobilize private investment. MIGA, it's the only entity that does it, okay? And quite frankly, with Africa being CCC+ median, if we don't have a risk reduction plan, then this will not work for Africa. MDBs and DFIs are not, even the MDB reforms are not talking about reducing risk at the level that's actually required. So Mark, maybe I'll reach out to you to see how can we do, obviously, with South Africa having the G20 presidency up now, unless African leaders step up and really realize it ain't working for Africa, it won't work for Africa. And standardization is just one. But the key is, look, we need to be reducing the risk. Otherwise investors are more than content to remain invested in developed countries. And with 1% of the 520 billion of MDB and DFI capital being used to reduce risk, that chunk of money isn't the risk reduction chunk. So maybe, Mark, I'll reach out to you, see how we can maybe get more excitement about reducing risk, okay?
Thank you very much, Chris. Yeah, fantastic.
You, Chris.
I'd like to thank you all very much for this very insightful and deep discussion. It was amazing to have you here on board, and thank you very much for the willingness to share your reflections, your insights. We touched on many aspects, on the need to mobilize more capital, on the aspects of de-risking, and also not losing sight of the impact that we want to achieve at the end. All this is very relevant for the PPP world. And I would like to close this here and hand over to Ziad for his closing remark. Thank you.
Thank you very much, Max. Really appreciate it. Before I say my closing remarks, I'd like to say a personal opinion on the whole topic, because I would like us to end on a positive note, in a way, on an encouraging note. Look, it is difficult to get financing for Africa. It is difficult to get financing for emerging markets. But we should also, at the same time, get out of the mentality of needing low interest rates in order to do projects. If you take the US, for example, some of the largest companies in the US were started with what are called junk bonds. They paid very high interest rates, but if they have a model that works, if they have a proposition that works, eventually there's a market for it. And if Africa is growing at the rates that it is growing at, which are very high rates of growth, there's ample business opportunity for projects, even with higher financing costs, to be successful and to deliver. So of course, we need to work on use all the tools that we have, and blended finance, most important among them, to reduce the cost of financing. But let us not wait until we have every time an acceptable low cost of funds before we start a project. I'm talking here to governments. As governments, every time governments sit and wait for the World Bank, the African Development Bank, for this entity or that entity to come up with some lower cost of funds. Do not wait for that, is my opinion. Just if you have a good project, go for it, even if the cost of funds is higher than what you would like it to be. So with that, I want to extend my sincere gratitude to our panelists and participants for their valuable contributions. This session has provided a deep dive into the structuring challenges of PPPs, highlighting practical models and case studies that demonstrate how blended finance can be a game changer in making projects more investable. At WAP, we are committed to supporting PPP professionals and public-private partnership units worldwide in advancing better structured, well-financed, and high-impact PPPs. I encourage you all to stay engaged, participate in WAP's ongoing initiatives, and bring these critical conversations in your networks. Do stay in touch with us. Do stay in touch with Convergence. We are two organizations that are working very hard to make PPPs possible in emerging markets. Also invite you to join us for the next webinar in the series. In the chat box, my colleague Jyoti Bisbee has listed a number of links for you to be aware of our upcoming webinars. Thank you.
I think we lost Ziad, so I think if everybody can use their emojis to applaud, to thank all the speakers and the time and effort, this really, really rich discussion. We cannot get to all the questions in just an hour and a half, but as Ziad said, we are here to present different mechanisms to you so that we all start thinking together. So looking forward to seeing all of you on May 15th. Thank you so much.
Thank you very much. Take care. Bye-bye.
Thanks. Bye-bye.
Thanks to everyone. Bye-bye.
Thank you, guys. Bye.